Good morning, everybody. It is Friday, September 24th, and we're going to talk a little bit of taxes this morning. I am going to mute everybody so that I can get through this. But if you have some questions, feel free to type them in the chat box, and I will try to address them. And this, for all of you, it's 9:31. I'll give about another minute for people to come in. We had a lot of people register. This is basically a follow-up to the tax update. I gave an update on the Biden proposal about a month and a half ago. The House Ways and Means Committee met last week, and they were supposed to vote on the proposal that I'm going to go through with you today. There's definitely some changes from the other one. I'll show you the differences. Of course, they didn't get to the vote earlier this week. I think they'll vote on it next week. So let's get started. And so before the goal for today, or the agenda for today, is I'm going to go over the income tax and the transfer tax landscape, where it's at now, give you a quick summary of the Consolidation Appropriations Act that was passed at the end of 2020, the American Rescue Plan of 2021, and then this upcoming legislation and where we're at as far as the tax status, the income tax status. So that being said, where we're at currently, here are the current federal income tax brackets, if you don't know them, for individuals. Okay, so these are all laid out here. These are your tax brackets based off of what you are making as far as adjusted gross income, and then long-term capital gains that you pay on assets that you hold, or investment assets that you hold for over a year, 15% or 20%, depending on where you at on the tax bracket. And then for net investment income and Medicare surtax on earned income, there's a 3.8 tax when you get to certain levels as well. There are other long-term capital gains rates that are for building recapture, that's at 25%, and then 28% for collectibles. And so these are just items of income taxes that we have in the current landscape right here. Okay. Federal income tax brackets for trusts and estates. And a lot of people misunderstand this. I'm an estate planning attorney, so I want to make sure you're clear on this before we go too much further on as far as how the federal income taxation for trusts and estates are. These are the tax rates for non-grantor trusts. A lot of people get confused between what's a grantor trust and a non-grantor trust. So most people that we work with will have a revocable living trust as part of their estate plan. Those are grantor trusts. What that means is the IRS doesn't care about those things for income tax purposes. Your personal income tax rates, the ones I was explaining before, will apply to those trusts. Okay, you don't file any separate returns or anything like that. The IRS doesn't care about those types of trusts. It's non-grantor trusts that these rates apply. And non-grantor trusts will occur potentially after death, when you pass away, or maybe in some specific tax strategies that you lay out. And so non-grantor trusts have compressed tax brackets, right? You have to just get to $12,500 of income when you have, or $13,250 of income to get to the highest tax bracket versus $500,000 for individual returns. And there's a couple ways you get around having these compressed tax brackets on the estate planning side. I'm not going to go into too much of the weeds, but you should be aware of them because some of the proposals affect grantor trusts. So that's why I'm giving you this background. So let's say someone passes away and we say we want to make it a non-grantor trust status, and there's income being generated in this trust for the beneficiary. If we leave the income in the trust, then those would be taxed at those tax rates. And if the beneficiary is in the highest tax bracket, then it really doesn't matter. But if they're not, we can just distribute that income to the beneficiary and they pick it up on their own personal income tax returns at their rates. There's a third way that we're building into our plans, and beyond the scope of this, but there's a way you can create a beneficiary, a beneficiary grantor trust once after you even pass away, that the beneficiaries are considered to be the grantors. And so that allows you to have your cake and eat it too, where you can keep the income in and have the income be taxed at the beneficiary's income tax rates. So I work with a lot of CPAs and people who think, oh, it's trust, we have higher tax brackets. No, they're compressed, and you have to understand the difference between grantor and non-grantor trust with regard to that. Sometimes we will specifically make, and these are very niche types of cases, where we want to make a trust during someone's lifetime a non-grantor trust, and we might cite that non-grantor trust in jurisdictions like Delaware or Nevada, or different jurisdictions where we might have favorable state income tax rates, or they give you favorable rules on that. So if someone's selling their business and they don't want to get hit with the Virginia 5.75% tax or Maryland tax, the state income tax, we can cite a trust in a specific jurisdiction. Certain rules got to be followed, but I'm just giving you, those are times when we specifically want to do that. Okay. So that's what a grantor trust is. It basically means for income tax purposes, you're the person who created the trust. You're going to be considered to be the taxpayer for that. Okay, now estate taxes, federal wealth transfer tax exclusion. So I'm going to go back down to 2011. This is what you can die with, right? Before the federal government says you are going to have an excise tax on your estate. And the current tax rate on this is 40%. And as you can see, these numbers have grown significantly. And a lot of people, these numbers, most people are well below these limits, but this is what each individual can pass away with. And in married couples, when we do the planning, we'll usually double someone's coupon. So currently, you can die with up to $11.7 million worth of assets. No estate tax due on the federal level. I'm not talking about states because I don't want to go through each state right now. Okay, so let's give you kind of the landscape, what's going on. The Consolidated Appropriations Act, that was passed in at the end of 2020. It was the longest bill ever. I don't know if anybody's actually took the time to read the whole thing, right? And the cost of it was $2.3 trillion. And about half of it was for COVID relief. Okay, in that Consolidated Appropriations Act, the Title II, it was dealing with the coronavirus response and relief. Those were the things that were put into that bill at the end of the year. And so, some of the things that came out of that are educator expenses. There's a whopping $250 above the line deduction for our teachers to deduct for expenses that they come out of their pocket with. They're now mandated to, if they want to buy their own masks and supplies for COVID, they still don't get any more. So there was a talk about raising it to 1,000. I said, why not? Or why not pay the teachers more? But just the thought, with that one. Cash donations by non-itemizers. This was in the Consolidated Appropriations Act. So this is something, if you're a standard deduction, if you take the standard deduction, you in 2020, if you made a cash donation to a charity, a public charity, it can't be a donor advised fund, but it has to be a public charity, you would get a $300 above the line deduction if you made that contribution per filing unit. Okay, so that would be for the family. 2021, you can double that as $300 per taxpayer. So if you do the standard deduction and you make cash contributions to charity of $600, you can get an above the line deduction, which those are better for that. So that's nice. For that was for 2020. The difference is 2021, they made it a below the line deduction, and that's in addition to your standard deduction. So that's the difference there. So that's nice, but they did phase out a little bit of the benefit of that deduction. I guess we're back on our feet again. They're not giving us as many benefits. The other things that were put into that legislation that are that I think people should know is your medical expense floor is permanently set at 7.5%. So let's say you have of your AGI. So let's say you have medical bills, right? Let's say your AGI is $100,000, and you had medical bills of $10,000, right? Then $2,500, anything over 7,500, 7.5% would be a below the line deduction for you on your medical expenses. Okay, they made that a permanent 7.5%. It went up to 10%, then they brought it down to 7.5 for the because of the coronavirus. Now they permanently set it at 7.5%. Deduction for qualified tuition and related expenses with higher income limits. So basically, if you're going to if you have a higher education like college or grad school and the like, you'll get some deduction there, but they put some limits on that. If you had to get a relief from your mortgage or loan, right? So that's cancellation of indebtedness. So that would be if you had a mortgage and could not pay and were forgiven $500,000, you're capped. Okay, and so you're capped at what you can. They would say, hey, if you received $375,000 of cancellation of indebtedness, that's income to you. But this provision says no, we're gonna give you the first 375, 750 if you're married. We're not going to consider that income to you if you have a canceled debt on your mortgage. They'll let you deduct your mortgage insurance this year as well. That's usually not deductible if you have mortgage insurance. And the one that I think is they're trying to stimulate the restaurant industry is for 2021 and 2022. Usually you get a 50% deduction for meals furnished by a restaurant for business meals. So this is for business owners. They're raising it up to 100% because they want to stimulate the restaurant industry. So that's a nice one for business owners. There's some rules associated with that. So you got to know the game because they don't want you to game the system. So going to a ball game is not a deductible deal. That's not considered a business meal. The transportation to and from a restaurant, if you take an Uber, they say that's not deductible. The club memberships, and then if you go to a ball game and go to the hot dog stand, that is separately charged and you can deduct that. But if it's some part of package deal, then you can't deduct it. Meals on the business premises. So if I provide my employees with meals on the premises here, I get a 50% deduction for the convenience. But if it's provided by a restaurant, then I can get a 100% deduction. Meals during business travel, 100% deducted. If I'm at a conference, it's provided by the restaurant, it's 100% deducted. Client business meals, that's what it's about, right? That's one of the big things that people will go out and network and the like. If provided by the restaurant, taxpayer is present. I don't understand that one. So if I'm taking someone out for a business lunch, I guess would I sit at a different table? Maybe I'm not sure about that. Why would I do that? But and so I'm not sure on why I'd have to be. I guess I'm going to be present. I hope I would want to be present. So anyway, that's the meal stuff. Okay, so this is all income tax things. Then we had the American Rescue Plan Act of 2021. This was all about the recovery rebates. If you met into the phase out levels, they phase out at $75,000 for individuals, $112,500 single filers, head of household, $150,000 for married filing joint. You got a recovery rebate. They're trying to help stimulate the economy from in response to the COVID pandemic. And child tax credits got expanded. Okay, and these were growing, right? And so those were nice credits if you met the phase out, if you were within those adjusted gross income levels. If you got your student loan forgiven, they're fully excludable from income from 2021 to 2025. So if for some reason you got your student loan forgiven, this is the time to make sure that you get that filed so that you cannot realize it as income. All right, so here's what's being proposed, and I'll give you the landscape. If you remember, there was a proposal by the administration, the Biden proposal, which we'll go back and we'll explain the differences here. Now, the House, they didn't pass it yet, but this is basically the proposal that will be passed once it goes here, right? And so the House has a bigger margin for the Democrats than the Senate, right? So once it comes from here, then it goes to the Senate. The Senate margin is razor thin, right? If they're basically, the vice president would maybe have to break a tie with regard to that. So that's the next step. And then they have a compromise. So I'm not saying this is legislation, right? And it's going to look different than this. One of the analogies from the commentator that went through this tax summit that I went to said it's kind of like a tropical storm that's been, that's out off the East Coast. Whether it's going to land as a Category 1 hurricane or tropical storm or Category 5. That's going to be, the proof will be in the pudding at the end. It's going to look different. Right now it's kind of brewing, and then when it lands and when it gets passed, and we think the legislation is supposedly would get passed in November or December, but it wouldn't surprise me if it got passed in January retroactive. Okay, it's just like Congress, just to do nothing, right? And just make sure that and so that's the main thing there, is we have to understand that these are proposals. That gives you an idea where people are leaning. Okay, so with that being said, with that disclaimer, the business tax proposals, they want to increase, there's an increase in corporate tax rate. And so the tax rates would be increased. Carried interest rules deal with more like hedge funds and private equity investments. And then limit the 75% and 100% exclusion under 1202. So there's something called 1202 business stock. It's beyond the scope of this this presentation to go into that, but that's a way you can own shares in a company. And there is a really nice benefit now if you do own that, and there's certain specific rules with regard to it, that again the gains can be excluded maybe up to 100%. But basically, you're going to find that the theme in the legislation is if you are making $400,000 a year or more, you're rich. And if you're not making that much, you're working, I guess. And so there's no comments on either of that from my side. It's just that's the line in the sand. So you're probably going to see your taxes increase if you're over that amount. Okay. And if you're below that amount, you probably won't see any changes. And a lot of these legislation, these proposals here, right, for the House, which are concerning some people, they want to make this effective last week, right, or 11 days ago. So it hasn't passed yet, but they want to make it effective September 13th. So it really makes it hard to do stuff now and so we don't know if that's going to go, but it's in the proposal. That's what they have, and so that's something we got to think about. Okay, so here's the proposal. Here's some of the things that are out there. So instead of the 37% top tax bracket that I was showing you before, now they want to restore the 39.6% top ordinary rate. Okay, so that's just moving that rate up from 37% to 39.6. And this is interesting, and this is different than the earlier proposal, is that now instead of the highest capital gains rate being 20%, now they want to make that 25%. Okay, so, and that's going to align, that's the same thing that if you were in that 20% bracket before, now you'd be in 25% bracket. And so some people are concerned about that, and they're selling stock, and I'm getting, emails from friends and the like. I sold stock after September 13th. Oh, darn it. Is that going to catch me? If this passes with that retroactive date, then yes, that would apply if you're in the top tax bracket. But again, this is a proposal. Senate's not going to go. The Senate's definitely going to be more conservative on that, and then there's going to be a compromise. So likelihood of this, I think it's lower, but it's there. It's in the legislation. And then this is another big one. applying a 3.8% net investment income surcharge. They call it a surcharge. I just call it just call it a tax. Call it what it is, right? 3% tax to active business income of S corporation shareholders. So I'm an S corporation. I'm an active. I work in my company, and now they want to tax me 3.8% more, basically, if you make $400,000 or more. So if you're underneath that $400,000 level, that would not apply to you. But that's the kind of the line in the sand. And for joint filers, it would be 500,000. Okay. And so that's a big one because we work with a lot of companies that are S corporations or LLCs that are taxed as partnerships that have passed through taxation. And so if you make more than those limits there, you're going to see a 3.8% increase in your tax, basically, in taxes that you pay. All right, that's the bottom line. The 199A deduction, this is a very specific deduction for pass-through entities. And I thought they were going to eliminate that, but they didn't. They just said, look, we're just going to apply the same caps as we did on everything else. If you're making more than 500K as a joint filer, 400,000 for single filers. I love that it's 10,000 for trusts and estates, non-grantor trusts, right? You would have a cap on that 20% below the line deduction that you're getting, which is a really nice deduction for people. I thought that was something that they would get rid of, but no, they didn't. And basically, it's just a cap on your income levels. There's another 3% surcharge. I love the wording. It's just a tax. And this is where your modified adjusted gross income, 5 million, right, for joint filers and single filers. So this is really, okay, if you make more than 5 million a year, great, good for you. But this is really, I think, applying to people who own real estate or business owners who are having that big liquidity event in 1 year. They're going to have that big income year in 1 year. This is where they'll tag a 3% tax on top of that. And again, $100,000 for non-grantor trusts and estates. Okay. All right, so here's the stuff that deals with estate planning and estate taxes. This was not in the Biden proposal, so this kind of perked my ears up. Is that basically the what you can pass away with now, right, is $11.7 million on the federal level. That legislation was passed in 2016 in the prior administration. And they did not have the votes in Congress. It was done through a budget reconciliation, which was probably what's going to happen with this as well, where they didn't have the supermajority, the 60 votes in the Senate, just went down party lines. So that legislation has to sunset, and it's sunsetting January 1, 2026. So if Congress does nothing, which I think is right down their wheelhouse normally, it will go down to $5 million on January 1, 2026, the basic exclusion amount, which you can pass away with. That is indexed for inflation. And what that means is it's indexed for inflation from a 2011 law. And so we think it would land around $6 million is the coupon per person. So if that level is not going to affect you, then this legislation would not. They want to bump up that timeline. Okay. So the timeline, they want to do it as of January 1 of next year. They don't want to wait till 2026. So that one I think has got some legs, and I was kind of expecting that in the prior proposal. Now they've actually put it in. And so I think this one has the most likelihood of passing, in my opinion. The second point is the increased cap on the 2032 special use valuation. These are for farms, closely held businesses. So again, the legislation to stimulate farmers, small business owners. They're allowing you a cap on, hey, if your farm, even though it might be in an area where if it was being used, if it was a high rise was built on it, it'd be worth 10 million, but you're using it as a farm, a special use, it should be only valued at $1 million. So that's what that's talking about. This is the one that this would be more of a game changer for me, that people, if this actually got passed, okay, because we do a lot of planning with this, and I'll show you how we do that planning. Is this new section 2901. They want to add a new section to the Internal Revenue Code, 2 sections, okay? And this is really the game changer, where some of the, it would eliminate a lot of planning or make the planning that we do more difficult. And the grantor trust reform, okay? And so these are ones where the include grantor trust assets in decedent's gross estate. Okay, so what does that mean? What the heck does that mean? So I talked to you about what a grantor trust is. And so I'm going to kind of bring it to light here. And hopefully my screen, I've shared my screen again. Let me see. So I know with my clients, you probably are tired of my dumb IRS supermarket story, but for those of you who have not heard it before, this will help you understand what is going on here. Okay, so the way, and I forgot to move my little cursor down here. Okay, so most people, if you're a married couple, a basic planning technique when you're dealing with estate taxes, okay, is that we will create, and part of a good estate plan is that you will have a revocable trust. So I have a Mike Smith revocable trust and a Sarah Smith revocable trust. And those revocable trusts, as we talked about it, are grantor trusts. So the IRS doesn't care about these things for income tax purposes. You file your same 1040s like you always do. You pay your same taxes like you always do. But within these trusts, we build in, so my IRS supermarket story goes like this. We have a husband shopping cart, wife shopping cart, and we're in the IRS supermarket. Everything in the supermarket is subject to death tax. I'm just talking about death tax. This is the checkout counter, also known as an IRS auditor. When you pass away, right, they want to know the value of everything that you own. You go over a certain number, tax you on that stuff. The parking lot is over there. The goal is to get as many assets from inside the supermarket out to the parking lot, right? Husbands always check out first in my plans. You can do whatever you want in your plans, right? Let's say the husband has 11.7 million bucks in his cart when he passes away. Gives the coupon. He has a coupon worth 11.7 million right now, right? Gives it to the IRS person. They scan it, bag up the assets, take all that 11.7 million out. No tax due. Got all of it out to the parking lot. That's option one. Option two, don't want to use my coupon. Leave everything on the belt to Sarah. Let her pick it up when she checks out. When she checks out, let's say there's a big estate. Let's say she has 11 million of her own. She takes Mike's 11 million. She's at 22 million. Anything over 11 million, since she has her coupon right of 11 million, 11.7, is taxed at 40% under the current laws. That's due 9 months from the date of death. That's for the beneficiaries to pay, right? So how does that visualize? How does that come to here? Mike revocable trust, Sarah revocable trust. Mike checks out. We use his coupon, 11.7 million. We put it into this. My clients call it a coupon trust or family trust because a lot of people kind of get confused on, hey, do we lose the money? No, it's just a name change. If you have a surviving spouse, they can be the beneficiary and control it. It's just a game that we play with the IRS. Attorneys will call it bypass trust, B trust, credit shelter, name it what you want. It's using your coupon, okay? And so we've got 11.7 here. If Mike had $15 million, we couldn't take all 11.7 out, or they would hit us. They would hit Sarah with a 40% tax. I don't want to do that. So anything over the coupon, we would create this other trust called a marital trust where Sarah's the spouse and so when she passed away, this would be added up to this, and she went over the tax. There would be tax due. This under the current law, they haven't changed this one yet. I can always defer estate tax where no spouses would be paying the estate tax. Okay, it would always be past the second. It would be the next generation that would pay, either the kids, whoever you have as beneficiaries behind the spouses. And that's basic taxation that's how the estate tax structure of most of our plans are. Okay, and so what do we do on advanced planning if you have a business? And so the coupons, right? So those coupons are 11.7. What I was telling you about before, they're going to go down to 6 probably, okay? They're going to go to 6 probably maybe January 1 of 2022, maybe 2026, depending on, how things go. I'm probably betting on next year. And so those things are there and you can lock yourself in. And so one way you can lock yourself in with a higher coupon and get grandfathered in, right, is you could say, I don't want to wait till I die to use my coupon because I don't know whether the coupon amount is going. I don't know what Congress is doing. And my assets are going up. I have a business that's starting to really skyrocket. If you're in that kind of situation, or your wealth is increasing and coupons may be going down, then you may be thinking, can I do something now? Or do I have to just sit on my hands? So as planners, we can just do the same thing. It's just this family trust who said, we don't want to wait till we're dead. Let's create and use Mike's coupon now. Okay. And the way we do that, we love acronyms. Our estate planning attorneys love we call it a SLAT. a spousal lifetime access trust. Okay, it's the same deal. So think about it. Mike created this one for Sarah's benefit. She's the trustee and beneficiary of this one. It's just after death. We said, well, why don't we just do it during our lifetime? Use the same rules the IRS has given us. Why don't we just say, Mike's creating this trust for Sarah. She's the trustee and she's the beneficiary. Okay. And so we have magic language in there. But now if I put $1 million, or if I put 11 million out there and they move the coupon down to 6 million, okay, I'm locked in. Okay. I've got that. And that is one way that you can do that. But there are some income tax issues you have to think about that are part of that. And so in the laws that we love as estate planning attorneys, we're allowed to make we again, another acronym, we can create what's called an intentionally defective grantor trust. What we do is we say, hey, Mike is creating this trust for estate tax purposes. All of this stuff is out of his taxable estate. But we're going to make one defect in it purposely. We're going to make it a grantor trust because we don't want to have non-grantor trust tax status for this, because we don't like all those bad rules that they have it. We want it to be Mike to be taxed on his own personal income taxes. Okay, so it's a grantor trust as to Mike. So do you see where I'm going with this? So let's go through that law again. Include grantor trust assets in decedent's gross estate. So just to hammer the point home, this is the parking lot. They want to move it over here. Okay, they want to say, oops, I got a lot. So they want to say, I don't care. It's a grantor trust. We want to move it back in. That's the big deal for me. Okay, because I don't like all those other rules that they have with the grantor trusts. And so I can't do my fancy stuff on that one. But we'll see. I don't know if that'll get through, but that's what I mean for that. And then there's other things. There's another big one for me is tax gain transactions between grantor and irrevocable trust. So sometimes, oops, now you see my nice, cool scuba diving screen. So now what we do, right? So let's say I have someone with a big estate, okay? And let's say Mike has 20 million and I can only gift 11.7 million over to this because that's his coupon, right? But I want to get 20 million in there. So under the current rules, I can gift 11.7 million and then I can sell the remaining portion over to this trust. But guess what? It's a grantor trust. So there's no taxable event. Mike's selling it to himself. There's no capital gain. And it's a way for me to overstuff this trust and not pay any income taxes. They don't like that either. Okay. And so there is a new provision that says tax gain transactions between grantor and irrevocable grantor trust. That's what that means. Okay. And so you would get grandfathered in if you can get things set up and actually funded into these trusts before enactment. Again, I don't know if this is going to be enacted. This is pretty groundbreaking. Okay. So remember what I think they might have added these two in. This is my humble opinion to get this one, right? You always, when you're negotiating, you start with everything and then you'll take two off the table, one or two off the table. I hope they take these two off the table. If they don't, I'll let you know. But that's where we're at. And then the other thing that I get to use a lot is these valuation discounts for transfers of businesses. So if a business is worth $10 million and we have restrictions in the business agreement, it's not a marketable security where you can easily sell it on the market. Is that $10 million really worth, is your interest really worth $10 million if there's a bunch of restrictions, you can only sell it to certain people and only get approvals? You get a little bit of a discount. So a $10 million business I can make look like an $8 million business and you get more. And they want to get rid of that too. Okay. And that would be a big deal as well. So those are the transfer tax proposals. The good news is if you remember the Biden proposals, those were some big differences. Okay. And we did not see this in this proposal, which is good, is that there was no repeal of the step up in basis. So if you remember, quick review, when you pass away, let's say you bought Tesla stock, right, for 100 and you sold it for 700, there's a capital gain of 600. But if you don't sell it during your lifetime and you leave it at death to your spouse or to your heirs, right, they can sell it for $700 because they get a step up in basis to the value as of the date of your death. And there's no capital gain. Hey, the IRS gives you one. You got to die for that one, but there's no capital gain on that. There's no repeal of that step up in this proposal, which is good. That's one that's important. Remember that step up in basis, you don't get it for IRA assets. IRA assets, there's no step up in basis on those. You haven't paid taxes on traditional ones, and the Roth IRAs, those are tax-free as well. They're tax-free anyway. No recognition of gain at death. So that was a big deal. Though they were wanted to, what the prior proposal is, hey, if you have $2 million worth of wealth at your death, it's as if you sold everything, your whole $2 million, and you have a cap, you've received $2 million. And so whatever basis that you paid for those assets, you paid, there's a capital gain on that. So we'd have to figure out all your cost bases of everything and make our jobs harder. They got rid of that one. Okay, so that's not in this. So there's no recognition of gain at your death. That would have been a big game changer. And then no mandatory gain for property. We have these things called dynasty trusts where we can keep things out in the parking lot for as long as they would allow you. They wanted to cap that at 90 years. That did not make the House Ways Means proposal. You're still getting a preferential rate for long-term capital gains. So if you remember, if you made $1 million in the prior proposal, then the proposal was you're going to be taxed at 39.6% for capital gains. That's not in this one. It just says 25%. Okay, so it wouldn't be at the 39.6%. And then the other one was, we have a lot of clients in our area who do what's called a 1031 like-kind exchange for real estate. Is they wanted to cap what you could roll over. They would say, hey, you got to start recognizing some of these gains that you sell an investment property and just plow it into another one. They wanted to cap that. That's not in this proposal. I guess Congress, there's a lot of real estate owners in Congress, maybe they didn't like that one. I'm not sure. And then the restrictions on grantor retained annuity trusts, there's no special restrictions on those. I'll show you an example of that when I go into like planning strategies. That's a nice safe strategy that estate planning attorneys usually use to reduce estate taxes. But you'll like this one. This is the Michael Jackson case that came. There is the estate of Michael Jackson finally had a ruling, so I figured you might want to know about that. This has nothing to do with the new tax laws, but I thought you would like to know that. So they said the image and likeness of Michael Jackson when he died, right? So we file as estate planning attorneys when someone passes away and there's a taxable estate, we'll file a IRS form 706 and list the value of all the assets as of the date of death. The estate said Michael Jackson's image and likeness was worth $2,105 on the date of his death. And the IRS said, no, we're going to issue you a deficiency notice of $434 million on the date of his death. The estate's expert said, okay, we'll go up to $3 million as the value of his likeness and image. The IRS said, no, we're going to go to $161 million. So they did come in a little bit. The tax court actually sided with the estate because if you remember when he passed away, his image was kind of poo-poo because of all those allegations and all those things that were going on with his name, and all the things that I don't want to get into now. So basically, that's it. That was a win for the estate. And if you recall that Michael Jackson bought the rights to the Beatles songs, and so he got into financial issues, and so he sold some of that to Sony, and he took a bunch of loans from that during his life, where basically all those assets that he got from the Beatles royalties, he was eating up with all these loans. So the estate said that was worth $0, his interest in that, because of all the loans he took. The deficiency was $469 million. The estate's expert said, no, it's still zero. And the IRS expert went down, but the tax court sided again with the estate. So if you do take a bunch of loans and it'll reduce the value of the estate. The estate lost the last one. It's Mijak Music. So just thought that was interesting. The tax court did say, hey, this one, you do have $107 million deficiency on this. You should have put that in there instead of 2.2 million. Interesting case. Thought it'll be out there for you. Here's some planning. This is what I think about on the planning side. if these things come through, it's the same thing I discussed last time if you were in my prior meeting. Basically, one strategy that we can employ to kind of lock in your exemptions, your coupons, and the like, are the one other thing I did not put in there, and it hasn't passed yet, but it is relevant to people, is if you're doing a backdoor Roth conversion, they in the initial proposal, it did say that they wanted to eliminate the backdoor Roth IRA. It hasn't passed yet, so we'll see. I'll let you know what happens. So the backdoor Roth is a way for people who can't contribute, who make too much to contribute directly to a Roth IRA. And forgive me to be basic, a Roth IRA is a type of retirement account where you put after-tax money into an IRA. It grows tax deferred, and when you take it out, it comes out tax-free, right? But if you make too much, there's income phase outs. I think it's like 170,000, give or take. Forgive me. But if you make more than that, then you can't contribute directly. So there's this loophole where you can contribute to a traditional IRA and then just keep it in cash and then just convert it to a Roth, because there is no ceiling on a conversion. So with the Roth conversion, those backdoor Roths, that is in the proposal to take that planning technique off. That would impact a lot of my clients. I see a lot of people do that. So I'll let you know if that actually gets through. All right, so back to this. So a way to planning strategy, I've been doing a lot of SLATs lately, spousal lifetime access trusts. And so it's just a way to, like I explained before, to lock in your coupon now. You create a trust for, you could be a spouse, could be anybody. They're the trustee, they're the beneficiary. You don't even have to file a separate income tax return because I'll make it a grantor trust, right? So there's no separate income tax. It's for the estate side, and you fund it before the end of the year. And so that way, those grantor trust rules do not apply to this. So you die with those assets in this, then they are outside of your taxable estate. That's one strategy that you can employ. That's one that we've been doing a lot of. There's pros and cons to it. Let me show you what the pros and cons are for them. So this is just basically laying out the same thing with the SLATs, locking your current higher exemption, ability to sell those assets. If you have maxed out your exemption, they want to get rid of that, right? That's in the proposal. Removes future appreciation. So if it goes up to 20, 30, whatever amount afterwards off of the IRS's rate for estate tax purposes. It's also an added benefit, provides good asset protection. So you got a higher level because it's harder to get into those assets. So the assets can be accessed through the spouse. So if you create one for a spouse, then you'd have not direct access, you'd have indirect access through your spouse. The pros are provides access to trust assets, investments. If you have, some clients are putting life insurance into this. Okay. And I'm not commenting either way, but life insurance seems to have a very strong lobby, right? And so those are one of the benefits that do come in income tax free. And there are strategies where you can take lifetime from cash value. I'm not getting into all that. But if you did employ that strategy with your advisor where you were using a life insurance policy to build cash value and take money out on a tax-free basis, the spousal lifetime access trust is a way to get those death benefits out of your estate, but still have access to that income stream. You can call it investments, business interests, real estates. And again, grantor trust. So income is taxed as though the client owns it individually. They want to get rid of that. Okay. The cons of the SLAT are there's no step up in basis. Okay. You can't have your cake and eat it too. If I move a Tesla stock out there for 100 and it goes up to 700, it's out of my estate. That doesn't count on my estate tax return. But if my beneficiaries sell it, okay, then they're going to take my basis, what I paid for it. So you got to figure out what's more important to you. And so what we've been doing is let's max out because the higher coupons, let's keep as much of stuff in the estate as possible until we go over that tax amount. But if they reduce the coupon, then we have to look at, that strategy. The other con is the grantor does not have direct access. So if you have to have that control and have to have direct access, then that's probably not a great strategy for you. You can get indirect access through the spouse or some other beneficiary. Flexibility can be built into the trust to account for changes. So these are irrevocable trusts, but we can amend them to conform with your intent. So there are ways that we can make them flexible. And you can unwind this if the spouse is a beneficiary. You can just distribute the assets out and you can unwind it if you don't like it. Okay, so it's very flexible on that side. A grant or retained annuity trust is a GRAT, is what we call them. You know, love our things, but this is an easy way where, hey, you're not using really much of your coupon. And it's because we have low interest rates now that this strategy is a good strategy for people to, it's basically moving high yielding assets out of your estate without you using a lot of your coupon. And so I think the best way to explain this one is just to show you kind of a quick example of it. So I'll give you a quick summary of it so that you see, and then I will just show you a quick example of it. A grant to retain annuity trust may be effective means for a wealthy client who wants or needs to retain all or most of the income from a high yielding or rapidly appreciating property. I think my business is going to go up a lot, or IPO or something that's going to transfer to the property to a child or other person with minimal or a gift or estate tax. GRATs are particularly indicated where the client has one or more significant income producing assets that he or she is willing to part with at some specified date. All right, so let me show you kind of an example of how that looks like. So let's say I put $1 million into this trust, right? So the basic idea, it says, okay, you put $1 million into this trust, Bobby, because the interest rate now that we determine, it's called the 75/20 rate, is 1.2%. It might be a little bit higher. I did this one in July. You're basically going to get back your $1 million over however long term that you want. We usually make these GRAT terms short, let's say 2 years. You're going to get your $1 million back plus that interest rate. Okay. Anything over that you make in your investment, that's going to be out of your taxable estate. So you're using leverage. So I'm making a zero gift. So if I don't have any coupon, they lower the coupon. I'm not making any gift, right? But if this asset is making, I just said 25%. So these are, this is a growth asset, right? And so $1 million, it grows to 25%. The payments required are, that are coming back to me over those 2 year period, it's $1,018,000, right? So that's basically me coming back with that little 1.2%. If I made more than that 1,018,000, which if I made this 25%, basically 428,000 goes to my beneficiaries in a trust for them, and I didn't use any of my coupon. That's the basic concept of it. Okay, I'm not going to get into the weeds of all that. Very safe strategy and authorized by the IRS. They wanted to get rid of that. It's a way we call them rolling GRATs, where we can just do a lot of these types of things on a continued basis. I think those are it for me. This just goes through the same example that are out there. So with that being said, I will kind of leave it with Michael Jackson there. If there are are there any questions, comments, concerns, let me know. I'll look in the chat. I don't think so. I will do the next time. I figure it'll probably be in November. I'll send out another update if you like hearing these updates and learning, from my side of it. I will send you the link for it. We'll go through it. So things are, we're getting closer. The next step is the Senate, right? And so we'll talk about what they think about all of this stuff. So stay tuned with regard to that. We'll see if that storm actually lands and is it a category 1 or is it a category 5? I think the thing to do now is just kind of, I would think that, the $6 million coupon is likely. So if you're kind of in that range, maybe we do have a discussion, just getting things kind of in order. I don't think, it's time to rip the cord yet. If you're certainly, if you're well over that amount, then you may want to be thinking definitely, that, because it's going to happen as far as the coupon. Either they do nothing and it goes down to 2,000, goes down to 6 million in 2026, or they just bump it up now, which I think is what they would do. All right. With that being said, I will conclude. I'll stay on for about another minute. Have a good weekend, everybody. Hopefully this was helpful for you. And you know, we'll keep kind of trudging along here. Have a great day. Bye-bye. See nothing in the chat. Great. I will talk to you all later.